Let's talk about how you can build the perfect crypto portfolio. You begin by planning it. You have to define your risk tolerance on a scale from 1 to 10, and then you plan your sector allocation. So how much are you going to allocate to meme coins, to DeFi, to deep-in infrastructure? I'm going to show you all the sectors and give you concrete coins in all of them. Don't worry. Then you make a prospect list. This is just a list of potential coins in all of the different sectors that you plan to allocate capital to. Then you turn that prospect list into a golden list. This is just removing coins from the prospect list that are either fundamentally weak or technically bearish, likely to underperform Bitcoin, that is. Because you don't want to hold altcoins that are likely to underperform Bitcoin. Altcoins are way more risky than Bitcoin. So if the potential rewards are not higher, the extra risk isn't justified. So we only want coins that are likely to outperform Bitcoin. Then we move to the execution phase. This is where we plan the final allocation to the coins on your golden list. And then we actually execute them, buy the coins. And then we have to figure out if we want to dollar cost average, lump sum, or dynamically dollar cost average, which is the best way to do it. So without further ado, let's get into all of these steps in detail. Hit the like button, hit subscribe, and click the link in the description. Let's get into it. Your risk tolerance is defined by 4 factors: your age, your financial situation, your family situation, and your risk appetite. Your risk appetite, that's just how much risk you want to take on, how much you would like to take. If you love gambling, for example, you have a high risk appetite. That doesn't mean you have a high risk tolerance, because that's how much risk you can take on. So there's a difference there. Your age, that matters, of course, because if you lose it all in your 20s, no one really cares because you have 40 years left to build yourself back up before you retire. If you're 64 and you lose it all, that's a big problem. So if you're old, your risk tolerance is lower. The financial situation also matters, because if you have everything in crypto and you lose it all, you're screwed financially. But if you have like $1 million in the stock market and you have 5 other rental apartments and then you lose it all in crypto, that's not such a big deal. So you have a higher risk tolerance if you have other assets, basically. Your family situation also matters. If you have people depending on you financially, it's just not responsible to take the same risks as if no one else is affected if you lose it all. So these are the 4 factors that you should keep in mind and rank yourself from 1 to 10. Here are some observations I've made from clients that I've worked with different risk levels. So if you have a risk level of 8, 9, or 10, you probably have no Bitcoin up to 20% Bitcoin and the rest in altcoins. The same is, you can just read the numbers here. So let's move on to sector allocation. And the sector allocation depends on your risk tolerance. So go ahead and rank yourself from 1 to 10. In my experience, most crypto investors are at a 7 out of 10. The goal of this step is to plan how much you're going to allocate to each of the sectors. And if you have a high risk tolerance, you want more red sectors. If you have a low risk tolerance, you want more orange sectors. And the green sector index, that's just Bitcoin. So let me walk you through the sectors and explain them. Index, this is Bitcoin. DeFi, that's decentralized finance. You have decentralized exchanges like Uniswap and Jupiter. That's an aggregator, but same thing. And you have decentralized lending protocols, which are the Aways and the Compound, that kind of stuff. So basically decentralized versions of financial services. Then you have DePIN. This is decentralized physical infrastructure networks. You have coins like Render, a cash network, Tau, and these are usually just computing platforms or marketplaces where you can buy compute or rendering services, GPU and stuff like that, and decentralized data storage. Infrastructure projects enable innovation in other sectors. So for example, Chainlink, that's probably the biggest infrastructure coin. That's an Oracle service. So they enable innovation on Ethereum, for example. Chainlink enables smart contracts to communicate with the real world. So you can build more types of applications on Ethereum if you use Chainlink. So they enable innovation in other sectors. So you have a Chainlink, you have Pyth network, you have GRT, those kinds of coins. Layer 1s, that's the foundational blockchains that everything else can be built on. You have Ethereum, you have Solana, Tooncoin, Sui, Avalanche, BNB, those kinds of projects. Then you have L2, layer 2s. These are other blockchains built to scale Ethereum. people have built other blockchains that can batch together transactions and send them as one to the Ethereum layer. So it makes Ethereum more usable and scalable. Then you have meme coins. Explicitly say proudly that they have no use case. They're only focused on community building and having fun, I guess. Then you have GameFi. This is everything that has to do with gaming. So games themselves, infrastructures around gaming, gaming economies, stuff like that. Then you have artificial intelligence sector, explains itself. And you have real world assets. So basically everything that has to do with tokenization of real world assets. So this is the sectors. And depending on your risk tolerance, you want to define how much you want to invest in the different sectors. Here's an example of a portfolio that has a risk tolerance of 5. So 50% goes to index, that's Bitcoin. 70% goes to layer 1s, so Ethereum, Solana. DeFi gets 10%, so that's Uniswap, Aave. Infrastructure gets 8, that's Chainlink, that's Pyth Network, DRT. Deepin gets 5, that's Render, a cash network, Tau. L2s get 5, that's Polygon, Arbitrum, Blast. Meme coins gets 5, so that's also like Dogecoin or Brett or whatever. And you can also diversify across market caps. So we have large market caps and medium market caps. If you have a higher risk tolerance, you also want some small market caps. In general, the smaller the market cap, the higher the risk, but also the higher the potential returns. So just keep that in mind. So depending on your risk tolerance, go ahead and plan diversification or allocation to the different sectors. I will give you more examples on portfolios and the diversification, and I will end with a concrete example of a portfolio that I built for a client. Just stay tuned for that. Then you make the prospect list. Okay, this is a big map of coins. You have the sectors, DeFi, Deepin, infrastructure, L1s, L2s, just the sectors I showed you a second ago. And then I have listed a bunch of coins to each of the sectors. So DeFi, you have Uniswap, you have Aave, Jupiter, PancakeSwap, Joe, Trader Joe. Yeah, so if you want to check it out, just pause the video, I guess. But then we take this prospect list and we trim it down to a golden list. How do we do that? This is the golden list. So how do we trim it down to a golden list? I'm mainly looking for 3 projects in each of the sectors. What you do is you fundamentally analyze the coins, and if it's weak, you remove it. What is fundamental analysis? That's just looking at what problem are they trying to solve and how are they solving it. That's basically fundamental analysis. So what are they doing and how are they doing it? And if what they're doing isn't needed, if they're trying to solve a problem that doesn't exist, then you remove it. If they are trying to solve a problem that exists, but they do it in a bad way, you remove it. If they're trying to solve a problem that exists, and they do it in a good way, and they do it better than everyone else, you keep it on the golden list. So that's basically fundamental analysis. Maybe I'll make a video about that soon. Then you analyze those strong coins technically as well. So you look at the price charts, and you should denominate the price in Bitcoin, not in dollars. That's next level thinking, but yeah, I won't get into it too deep. But you analyze the coins technically to figure out, is this coin likely to outperform Bitcoin? If it's not, you remove it, because you don't want the added risk without the added potential returns. So then you're left with a golden list of fundamentally strong, technically bullish altcoins across the different sectors of the altcoin market. This makes portfolio management and building so much easier just to have this list. Then you define your final allocation based on this list. So remember how we planned our sector allocation. For example, let's say you want 10% in DeFi, like this. Then, okay, you should spread your 10% across these 3 coins, depending on which one you think is most bullish. So I think Brett, I'm bullish on Brett. So I want to spend 7% of my 10% that's allocated to meme coins on Brett. I want 2% on Dog and 1% on Pepe. And then you do this for all the sectors. You take how much you're going to spend on that sector, and then you allocate it to the different coins on your golden list in that sector. All right, then we go to allocation. And this is actually a portfolio I built for a client. And you can see I put 30% in Bitcoin, 10% in Ethereum, 8% in Solana, 4% in Sui, 4% in Toon, so on and so forth. And this is the sector allocation or diversification. 30% in index, 26% in layer ones, 16% in DeFi, 8.5% in infrastructure, 9% in gaming, 7.5% in meme coins, and 3% in DeFi. And across market cap, it looks like this. We have 52% in large market caps, 31.5% in medium, 9.5% in small, and 2% in micro. So that's the super small coins with huge potential. That's probably GHX, I guess. Yeah, that's a DeFi, gamer coin. So this is the final plan. You have allocated percentages to all the coins on your golden lists, and it fits your planned sector diversification or allocation. Now it's time to actually buy the coins. The goal of the execution phase, and this is important, is to get the lowest average buy price that you can get without taking on too much risk. Because if you dollar cost average DCA, you spread your buys over time. Let's say, for example, I have $1,000 and I want to invest it in Ethereum. If I dollar cost average, I might buy $100 a day for 10 days. That's dollar cost averaging because you spread your buys over time. If I lump sum, I just throw the 1,000 right at Ethereum as soon as possible. And the difference here is that if you time the market well with the lump sum investment, if the price of Ethereum goes up tomorrow and I bought everything today, then I'm rewarded for it because I timed the market. If I dollar cost average and the price goes up over time, my average buy price goes up over time. But the opposite is true when the market goes down. If you buy everything today and the price decreases tomorrow, then you timed the market bad and your average buy price is higher than if you just bought daily while the price was decreasing. But that's the dilemma between dollar cost average and lump sum. There's a mix between the two, dynamically dollar cost averaging. And that's when you dollar cost average, but not the same amount every day. If the price goes down, you buy more. If the price goes up, you buy less. That's the basic idea of dollar cost averaging dynamically. Personally, I like to do it rather aggressively, actually. Say I have $1,000 I want to invest in Ethereum. I would probably buy like $400 immediately. So lump sum $400. And then if the price goes down tomorrow, I will lump sum 350 maybe. And if the price goes up, I would probably buy for like 200, so less. And I will buy according to the price movement. So if the price goes down, I want to buy more. If the price goes up, I want to buy less. But I always start with a rather aggressive first purchase just to get in. Because if the price goes up tomorrow, I would hate myself if I didn't buy a lot today. And if the price goes down tomorrow, I can just buy more. So that's how I do it personally, at least. All right, let's try to make a summary of all of this. You begin by defining your risk tolerance from 1 to 10. The factors are age, financial situation, family situation, and risk appetite. Then, based on your risk tolerance, you plan out your sector allocation. How much are you going to spend on meme coins or DeFi, all of the sectors? Then you make a prospect list with potential coins from all the sectors you're going to allocate capital to. And then you strip that down into a golden list by fundamentally analyzing all the coins and then technically analyzing them to figure out if they're likely to outperform Bitcoin. Then in the execution phase, you find the final allocation that you're going to allocate to the golden list or the coins on your golden list. And then you actually buy the coins either by DCA, lump sum, or dynamical DCA. Personally, I like to aggressively, dynamically dollar cost average. So I buy a lot immediately and then I buy according to the price movements. And if you want to see my portfolio that I actually built by going through all of these steps, click the link in the description. Remember to hit the like button, subscribe, and I'll see you in another video. Thank you.